Well, thank you so much for joining today's webinar, the quarterly market update talking about Q1 of 2021. I'm with my colleagues, Peter and Adam, and we're really excited that you could join us today. So thank you so much. We would really enjoy connecting with you. So if you would like to schedule a follow-up conversation, whether you're a client, prospective client, or a friend of the firm, please use the link that's going in the chat box right now to schedule a follow-up conversation. You can actually just see my calendar and book right in. As well, please send us any follow-up comments, notes, suggestions. We have been getting a lot of great feedback since we started these webinars, and every time it helps us improve and just improve the content that we have going out to our audience. So thank you so much for all of that feedback, and thank you for continuing to join our sessions. Today, what you're going to see is some similar material as we want to be giving you an update from the last quarter. And as well, we've added in a few special edition content for today, such as, what happens if you miss those few key days invested in the market, and how investing in real estate compares with investing in the stock market. So we're really looking forward to today. Without further ado, let's dive in.
Well, we talk in investments a lot about volatility. So let's look at volatility from a human perspective. How do you feel during the years that you are an investor? Your emotions can be, in fact, quite volatile. You start off on the graph on the left, you're optimistic, you've invested money in stocks, and you hope things will turn out to your benefit. Stock values go up and you're elated. This is a fun journey to be on. But then there's a stock market correction, and all of a sudden elation turns into nervousness, and heaven forbid the market keeps going down and you just get plain fearful. And then back up to being optimistic. So just be aware that there's really one reason why you have these feelings, why we all have these feelings. And that one reason is because we're all human. When things go up, we do get happy. When things go down, which is part of the normal investment cycle, then we get very nervous. Just be aware that that's just a human characteristic. If you ever want to talk to us about how you're feeling at any particular stage, please, by all means, give us a call, and we would love to have that conversation. But just realize this is a normal part of investing.
So that's a great point from Peter, a normal part of investing. Now, how can we quantify that investors' fear? What we've tried to do here is measure it with a volatility index. This is essentially a barometer for investor uncertainty in the market. I'm going to highlight a couple points of this graph. We see in March in last year a very, very strong peak. So there's a lot of uncertainty around COVID, how the market was going to react, how certain companies specifically were going to react. And since then, we've seen it drop off drastically, which is good. It means investor confidence is returning, asset prices should be rising, and employment is rising as well. Now, focusing on the last quarter specifically, what have we seen? We've seen a 28% drop in the last quarter alone, highlighted right here. So it hasn't come without any ups and downs. It hasn't been a smooth drop. We've had peaks and troughs, as to be expected. But how is that overall decline in investor uncertainty translated to the S&P 500 prices? Well, we see that they're actually negatively correlated. So as investor uncertainty has fallen down, the asset prices in the S&P 500 have substantially gained, over 7% through the quarter. Now, like volatility, this hasn't been a straight line uniform gain. Investors have experienced lots of ups and downs in this quarter alone, highlighted with a couple troughs down here. And it's important to note that after these troughs or dips in the market, what happens in the following days? There's often very strong rebounds to new highs. Now, we want investors to have a very long-term perspective so that when these drops do happen, they're not pulling out and missing some of those best days.
In terms of missing the best days, and when you get fearful, and I've had people tell me this over the years, they think if they're not in the market, the market's going to go down because the market seems to know what they're doing, and So if you had invested $1,000 into the S&P 500 50 years ago, ending last year, that $1,000 would be up to $121,000. But if you had missed the best one single trading day, the day that the market increased the most in that whole half a century, your return would have been reduced to $108,000. If in that 5-decade period you missed the best 5 trading days, now suddenly you're looking at a $77,000. Continuing that slide, missing the best 15 days, you're down to $43,000. And finally, if you miss just every other year, 25 of the last 50 years, if you miss the best trading day, your return will not be 121 that we saw at the start of this slide, but you'd be down to $26,000. If you're going to be an investor, it's best to be a long-term investor. Now, we do appreciate your circumstances might change. There might be reasons why you might change your allocation to stocks and bonds or other considerations. That's fine, that's normal. But to react in a short-term basis to the market, when you've really invested in the market for the long term, that generally comes back to haunt you. I love this slide. We call this, with affection, the checkerboard slide. Don't be too concerned about the details. We'll explain what we're trying to do with these various colors. The colors represent 8 different asset classes. So what are the different places you could invest your money? One color would be Canadian stocks, another would be global bonds and other investment categories. Now, for people that have a tendency to want to time the market, you always want to buy the winners. So of course, let's just see at the start of this 4-year plus chart, looking at quarterly returns with the best returns in the top row, the worst returns in the bottom row, and ranked from top to bottom according to how they performed that quarter. Let's highlight the top row for the first 5 quarters of this graph. Now, if you were inclined to want to kind of outthink the market and be ahead of the market and know where to put your money, and you saw that one asset class, which happens to be emerging markets, but you saw that one asset class outperforming time in, time again for 5 straight quarters, well, it's time to bet the farm. Like this is absolutely a sure thing. We've got to go all in on that. Well, let's just see what happens during the next 6 quarters. Focus down on the bottom, the worst investment category. For 4 of the next 6 quarters, that all-star can't lose winner of just recent days has now become the dog of the portfolio. I would encourage anybody that thinks that it's humanly possible to, in advance, knowing what color is going to pop up on the next quarter, I just don't think it's possible. So again, unless your circumstances have changed, if you are investing in stocks, you're typically taking the long-term perspective, stay invested, capture the market returns when they occur, and don't try to outthink the market because that just usually ends in failure.
So how has the market compared to the real estate market? Well, the real estate market has been skyrocketing, and I'm sure everybody has a story about either themselves or their neighbor or friend this past year trying to buy or sell a home. And it's been going up a lot. So we wanted to look at how certain areas of the real estate market has compared to the market, and we're going to use the S&P 500 as a proxy. Well, for Hamilton, Burlington, Kitchener-Waterloo, Oakville, Milton, and the Greater Toronto Area, since January 2005 to March 2021, what we've seen is returns anywhere from about 3.84 times to 3.3 times growth. When we look at that compared to the S&P 500, what we've seen is, if we just go to the next slide, is 3.36 times growth over that same time period. So it's relatively comparable. Now, we're not considering factors such as When you own your home, you have property tax, you have maintenance that you have to pay, utilities, etc. And we're not considering the fact that you're probably not buying just an index, and there are fees associated and days you get in and out of the market. But at least it gives us a rough comparison. So if this is relatively the same over a period of time, we're not sure if that's necessarily repeatable. So we wanted to address, how do we think about when we buy real estate? Well, if it's for your principal residence, you're buying it. Yes, maybe it is the large part of your portfolio. It could be the largest asset out of your whole portfolio. But you're choosing your home not based solely on an investment perspective, most likely. You're basing your home as, where you want to live, where you want to raise your family, things like that. Now, if you want to be buying rental property, so this is a question we get asked a lot about, is either should I be selling my rental property or should I be buying rental properties? Well, it depends for every single person whether or not that makes sense for you. If you're buying a rental property and it's going to now be a pretty substantial part of your portfolio, are you buying in the same area that you're living in to make it easy to manage it? Are you paying somebody to be the property manager of that? Is that really the best place from a tax perspective for your money? And then are we putting too much of your eggs kind of in one basket, too much investments in one area versus diversifying outside of the real estate market in one area? Well, a real estate developer, those people we would assume have certain expertise in certain areas, and they're adding additional value to this property regardless of what the market does. So that I would consider as another separate item. For all of our clients, you actually own part of your portfolio is in real estate, and it's globally diversified real estate. So that's a great way of being in the real estate market from a more diversified perspective. So if we're saying that don't put all of your money in one area, in one market, where else should we be putting our money? Well, that brings us to the drivers of expected returns. So if we're going to be building a portfolio, we want to be looking at, what are those premiums that have historically outperformed the market, and where are we going to have the best place to grow and preserve capital for clients? Well, as much as possible, put money in the equity market versus the bonds. And then we want to look at other factors of ways of classifying stocks. These can be things like how large is the company? Is it a small company or a large company? We want to own both, but we want to make sure we're including the small companies and tilting a little bit towards that in the portfolios because those historically have done a little bit better over time. And Adam's going to speak to that in just a moment. And relative price. Is it a value company? Is it a growth company? We want to own both in the portfolio, but we want to tilt towards value, which has historically done a little bit better. And profitability. We want to be invested in more profitable companies. That seems relatively intuitive. So when we've looked over the past quarter, how have these different areas and drivers of kind of better expected return performed? Well, let's highlight just a few that's on the screen. So for the Canadian market, small companies, almost about 10% return this past quarter. Same, we see this across the board from US and international as well. Pretty good returns. We've seen a lot of positive numbers in almost all the categories, as you can see on this screen. This is not the only ways of classifying companies, but these are the ones that we're highlighting based on those drivers of expected return. So, and then the value companies. So companies considered value versus growth. Value has been doing really well this past quarter. Where we haven't seen as strong of growth is the fixed income area of a portfolio. Now, the fixed income area for our clients, it is designed to actually help stabilize the overall account. Typically, it's where you're withdrawing your retirement money that you need to spend in retirement from that. And that's because right now, yes, the bond market is down. However, over the long term, we would expect that it would not be as volatile, not as many ups and downs. Whereas the stock market, we would expect a little bit more ups and downs to capture those better returns over time.
Thanks, Jennifer. And when we're speaking about over time and capturing those returns, we want to look at as long a time period as possible to get accurate measurements to help us predict where the returns are going to come in the future by looking at the past. So what we have here is each of those dimensions being company size. We have the relative price. We have those value companies versus the growth companies, and the highly profitable versus non-profitable companies. I'm going to focus in on the chart that you see here at the US market. So in the US market, we want to look at that because one, it has the longest time frame that we can measure, 1928 to this most recent year. And two, in terms of a market leader, it controls over half of the global market capitalization. So many companies are domiciled in the US and are built in the United States and publicly traded there. So we're going to go through each of the factors in the US market and look at, have those factors been persistent across time periods? When we look at company size, we want to look at the returns of the small companies versus the returns of those larger companies. And we see that on an annualized basis, those small companies are producing excess returns. When we look at the relative price metric one below, we see that those companies that are classified as a value company rather than a growth company are producing more than 2% annualized returns. And the profitability, the same trend continues. Highly profitable companies tend to produce a higher return than lower profitability companies. Now, we see that this is persistent across time and pervasive across markets in Canada, in the United States, emerging markets, and international markets. So what we want to do is we want to understand the data and say, if we're able to take our portfolio and tilt toward these companies that give us a higher expected return, we'd like to do that. And we'd like to build a portfolio that does that for us. Now, although these are positive returns and premiums across all markets and across very long time periods, is it positive every year? Well, in fact, it's definitely not positive every year. Just as the stock market has its ups and downs, its ebbs and flows, these values will produce positive results on an average basis, but have both positive and negative results based on the year that you're looking at them. A great instance is the most recent 10-year period ending in 2020. We had growth companies. Think about your highly tech companies outperforming the value companies very, very strong in the last 10 years. But we want to switch our investment philosophy just due to the last decade. The history would tell us not to do that, as there is much more prevalence of value companies continuing to drive stronger returns over a long time period than those growth companies. It's important to understand your investment philosophy and where your portfolio is tilted so that you can remain steadfast in your approach to investing during those down years.
And as always, we like to cover what else can you be doing. So some of the tips today around what else can you be doing to help your portfolio is invest your money. We've had Peter explain to us that if we miss those key days invested in the market and how detrimental that can be to our portfolio. So when you have money, have it invested. You can keep some money, as some people like to keep varying amounts as that cash in case of emergency money. And then depending on what you're trying to achieve in the next several years, you might be keeping some more liquid money. But, you know, if anyone taking any accounting course has probably heard the term cash is king. Well, we kind of think we're not sure if cash is king. From a personal perspective, keeping cash basically means every single day you're losing money with inflation. Having access to capital is definitely important, but then figuring out that right mix for you of how much money can be invested for the future and how much money do you need for more short-term needs, and then what kind of investment experience do you want, will really help to figure out how much money can we actually invest in the market, and let's make it invested. There's been a lot of different studies around, should you be waiting for those moments in time to invest in the market? Should you be investing a little bit of amount, maybe on a monthly basis over time to be invested in the market? Ultimately, the research really shows that the best course of action is when you have the money to invest. And then, of course, we can always be rebalancing portfolios as needed, making sure it's the right mix for you. Another thing that can help with, figuring out that right amount to be investing, regardless of the stage of life you're in, is budgeting. It's also regardless of how much money you make, spend, save. Budgeting can mean different things for different people, but I think the overall exercise is something that everybody should be doing. Do it as often as you need to. Maybe a minimum once a year would be a good start. For some people, it might mean really just laying out every single line item. For others, it might be more the bigger picture, conceptually saying, okay, I'm close to retirement. I'm in my last 5 years maybe of working. Am I really going to be able to achieve my retirement goals? What's that gap that I really need to be saving for? And maybe it's that. So it's a bit of a bigger picture perspective, but it's definitely a very important tool to do. And as always, cash flow projections. We really stress this because it is so important to, at any stage of life, to be looking at the cash flow projection, because it helps empower financial decision making. It helps bring those day-to-day expenses, makes us think a little bit better about the long term. So it can show us that long-term horizon of maybe building up to retirement, or even once we're in retirement, there's still a long time horizon. And we want to see what the overall portfolio will do based on our spending and saving patterns and investment returns. So this is a really, really important exercise. Make sure you're doing this at minimum once a year. All of our clients, this is something you do once a year. It's something we actually track to make sure you do it once a year. So make sure you've done this. And as always, other actions you can be taking. All of our clients, that on the financial planning priorities document, you have the tax strategy outlined for you in the estate planning. And this is ongoing looked at because your circumstances change and the government rules will change. And so we want to make sure that it's always still the best plan for you. And for anyone who's not our client, we often see with prospective clients' accounts that the portfolio plus tax planning and estate planning, there's often some really low-hanging fruit items that we actually don't see optimized. So if you'd like a free portfolio review, or if anyone that's listening to this conversation right now would like to send this free portfolio review to a friend that would benefit from it, there's a link going in the chat box right now. Please use that. You can actually just schedule a meeting with myself. For this one, we'll need a little bit of information beforehand to give this analysis for you. And make sure you're working with a team that you feel very comfortable with, that you can be open and honest about with your goals and your values, and have those conversations. Please make sure you're signed up for our emails if you're not already. We will send out interesting material as well as invitations for our upcoming webinars. So that way you make sure you don't miss anything. So if you're not already signed up for those, please do. As well, we have an Instagram account, Facebook page, YouTube account, and LinkedIn, as well as my personal LinkedIn. So please follow us on all of these different platforms. You can search watson.investments or Watson Investments to find us. And thank you so much. Our next webinar we have coming up is with Sue Hyatt, who's the CEO of Silver Sherpa. Our conversation is going to be around managing transition. So this is whether or not it's you personally need to be looking forward to the future for managing those transitions, or whether you're going to be the power of attorney or executor helping somebody manage transitions. It's going to be a really interesting conversation. I will be moderating Sue, and it's going to be an hour long on June 1st at noon. Please email Adam for the registration link as well. It'll be coming out in our emails. This is a conversation that's open just for clients and clients' guests. We will be recording it though, so the recorded copy will go on our YouTube page after. And thank you so much. Please reconnect with any one of us. We'd love to hear from you. And thank you so much for tuning in today, and have a wonderful rest of your day.